Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about debt. We're talking about financing, which can be your friend or your foe when it comes to commercial real estate. Please welcome my next guest. It's Ann Hambly. Ann is CEO of First Service Solutions, and they are the CMBS advocate. So they help borrowers with restructuring, with setting up CMBS loans and request. You know, sometimes CMBS loans can be a little more difficult to deal with. I think sometimes as borrowers and brokers and advisors with CMBS, we're like, what is wrong with these people? Why won't they work with us? Well, now we have an expert to talk to. Ann, thanks for being with us on Skype today.
My pleasure, Michael. Thank you for having me.
Well, Ann, the first thing I'd like to get your advice on is some tips for borrowers going into CMBS financing, because like when you acquire a property, you want to plan your exit strategy, you know, when you acquire it. When you acquire debt, there's some things that setting up that debt could cause issues down the road. What are some tips for borrowers there?
Absolutely. There are quite a few these days. CMBS, people know it affectionately as 2.0, but it's the CMBS loans that were originated after the crash of '08, really. And those loans have been really, they've moved in the direction of being less borrower friendly and more lender friendly. And there are some terms in these loan documents that can be quite, I want to say deadly for owners if you don't know they're there. So if you don't mind, I want to just go through a few of the hot ones, the big ones that I think cause people the most shock. One is, the biggest one I think that I find financially anyway is there's late fee language always in a loan agreement, and the late fee language needs to exclude the balloon payment. Otherwise, so add 3 words to your loan documents in the late fee language, excluding balloon payment. Otherwise, what's happening today and will happen on your loan at exit is if you happen to pay your loan off a day after the maturity date, you'll be facing a 5% usually late fee on the whole balance of the loan. So that's an example of, 3 simple words, and it can save you, on a $30 million deal, it saves you $1.5 million later on. So it's really key. Another one is there's provisions in these documents now that the lender at their own discretion for no reason can just reassess the adequacy of your reserves and then just change them on you at any point. So that's, to me, quite troubling. And a third one is there's springing lock boxes that you'll see often in these loan documents, and I think people are familiar with that generally. But the troubling thing is they're triggered based on a debt service coverage threshold, and that debt service coverage itself is calculated by the lender, or the servicer, of course. So using market vacancy, market management fees, market rates for leases, they calculate the debt service coverage ratio. So even if you're doing really well in your property and they calculate it at a certain point, it will trigger cash management. And I have worked with a number of owners that have gotten a new loan in even 2014 that have had their debt service fine on their end, isn't good when the lender calculates it, and all of a sudden now their cash is being managed for presumably no reason. So that's another big one.
That is a big one.
Probably the last, it is, and it will hit people by surprise generally if they haven't, of course, heard this. Another big one is the securitization industry, of course, is completely dependent on the originator being able to sell the loan and being able to sell it on Wall Street at a predictable price. I mean, that's the whole basis of CMBS lending. So in order to protect the lender, what they've built into these loan documents is a provision by which they can actually modify the loan proactively on their own after origination, but at securitization, so that the loan is more securitizable. That's a lot of words there, a lot of big words. But so if you got a loan and you signed the documents and you got terms, and 2 months later they get ready to securitize that loan, and they can get a better execution if your loan just had slightly different terms. You're agreeing proactively in these documents to not only go along with whatever those modifications would be, but to also incur the cost of all the modification to the documents. So that's a pretty shocking paragraph that I think most people don't quite know what it even is meaning when they sign it, but it has a pretty huge ramifications later on.
Yeah, that's crazy. So you're signing a document that says, "All right, just change the terms of my loan at your whim," and some of these other tips are fantastic. And we're talking with Ann Hambly with CMBS, advocate with First Service Solutions. And I want to ask Ann after the break in the next segment about some restructuring. It's pretty amazing what can happen in restructuring in a CMBS loan and how different it can be than a bank loan. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty, Asset and Occupancy Solutions. Xceligent, building data everywhere. CCIM Institute, the industry's global standard for professional achievement. Valuate, easily share what-if analysis with colleagues online. And First Service Solutions, your CMBS borrower advocate. For more information on how these businesses may be of service to you, visit creshow.com.